Good morning, everyone. This is Joseph Trevisani from Worldwide Markets. I hope everyone can hear me. Good morning, good afternoon, and good evening. Today's topic, or webinar topic, I hope some friends of mine from work tried to use the room. You may have heard some sounds in here. Today's topic is the future of, the case for optimism in the U.S. economy. By the way, I know it's August in Europe, and so I thank everyone for attending. I know it is vacation month in Europe. It's sort of a vacation month here in New York, too. So let us begin. And actually, I had some interesting news. There was actually some interesting news today over the past 2 days, which is utterly emblematic, although one of my college professors told me never to use adverbs when you don't have to. Utterly is an adverb. Which are very indicative, emblematic, if you will, of our changing world. The first was the trade balance figures that came out today. They were $10 billion below what economists had expected. Now, the way that economists, you always hear these figures. The markets like to trade against expectation, not against reality. I suppose there's some sort of philosophical oddity in that we could talk about another time. And what they do, and they do this free, FX Street does and others do it too, some news organization will simply, Bloomberg, Reuters, FX Street, others to come, I'm sure, will simply poll. The reporters will call up or they'll send out an email. And what's your estimate for this particular statistic? They run an average. That's what they have. So there isn't anything that's particularly accurate about these estimates, the expected numbers that you're always hearing quoted against. So you shouldn't put too much stock in those things. It's far much more. As far as trading goes, yes, the expected will get, in theory, baked into the number, and then the reaction, the trading response will be against that expected number. But as far as your analysis of economies go and of long-term trends, the primary thing that's important, of course, is the trend in the actual number, not the trend against expectation. And I just wanted to talk about this because I think it is so emblematic of our changing world and how quickly it's changing. Whether this is good or not, I guess we're going to leave it to our kids and our grandkids to figure out. My kids are 5, or they'll be 5 next month. What will their world be when they get out of college in 16 or 17 years? Some things we can project. And the sale, now there's a very well-known paper in the United States. For Americans, the name will be familiar. The Washington Post. It's the daily paper in the Capitol in Washington, D.C. It became enormously famous, iconic, if you will, as much as I dislike that word, for the Watergate scandal, which, believe it or not, was 40 years ago in the early 70s. Basically famous for taking out a president, Richard Nixon, who actually had a house right near where our office is in Woodcliff Lake. We are actually in northern New Jersey. I live in New York City. That paper was sold to out-of-pocket expenses, meaning Jeff Bezos, the founder of Amazon, bought it himself. He did not have Amazon buy it for $250 million. 10 years ago, that paper and its subsidiaries would have sold in the billions or more. I don't have a good estimate on it, but a good comparison would be, in 1993, the New York Times bought a relatively small Boston paper, relative on a national scale, called the Boston Globe, for $1.1, I think, billion. That's 20 years, almost exactly 20 years ago. Amazon was founded, I think, in 1994 95. Those are the 20 years that we're all living in, which we're all right here on our web. Over the weekend, the New York Times company sold that Boston Globe paper, and I think one other small paper attached to it, for $70 million. 10 years ago, 2004, I believe. Well, it's not quite. And oh yes, I forgot to mention, as I often do. If anyone has any comments, criticisms, information that they'd like to share with us, or a question, please just type it into the chat. I'll be glad to stop and answer it, or at least discuss it if I can't answer it. And we'll talk about it. I prefer to conduct these webinars as classrooms rather than lectures. Yes, well, think about inflation, because inflation would have taken it the other way, right? And there really isn't any deflation. There is disinflation, meaning that the inflation rate has come down, but it hasn't. Japan has had actual deflation. We've not had any here. So one of the most important. No, I don't think Ben's to blame for this. DARPA is probably to blame for it. The people who invented the internet. I know Al Gore said that he did, but I don't think he did. Anyway, so the news business, the information business, in 10 years, in 2004, my guess is they would have gotten more than $1 billion or more for this newspaper, but they didn't want to sell it. It was family owned. In 10 years, in under 10 years, digitization and the web have entirely changed everything about news and information distribution. Now, we all know this, and we're all living with it every day, and we find it very flexible and very adaptable. But from a business point of view, it's rather astonishing. We also had the example recently of Detroit, but we won't talk about that. The other thing that happened today, actually, was the trade balance, which came in $10 billion less, about 34 rather than 44 as expected. Okay, maybe people are buying less, maybe we're exporting more. That's true. Both are actually true. But the change in exports and imports were driven by oil. The U.S. is importing far less oil, and it is actually exporting finished oil products. And that is the biggest change. If you look at the oil production in the United States, it's got a lovely rising slope. This does, of course, tie into our topic for today, which we will now start. This is a graph of the U.S. GDP over the past 10 years. Let's get a longer-term graph here. Get a longer-term graph. U.S. GDP 30 years. Okay, this is a graph of the 30-year GDP. Let me just get these little chat boxes out of the way. So anyone who wants to talk, no, Blended, let me know. Okay? Oops, sorry. Okay. So this is the 30-year chart of U.S. GDP. The topic is, what is the case for optimism in the United States? When you look at the U.S. economy, there are two ways to look at it. Well, there are probably many more than two ways to look at it, but I'm going to look at it two ways. There's the internal way, which means that we are comparing U.S. economic performance to its past history. In which case you will say that the performance in this area here since the recession and since the great financial crash has been very poor. I have moving average. These are quarterly year to year. I know this is not the number you're used to because the number that comes up, the U.S. Everyone else does quarterly and then quarterly and year to year. The U.S. does annualized quarterly, so you don't have quite the same number. So I chose the GDP year to year quarterly measured because that compares with the same type of measure that the comparison I'm going to make with Europe and China and other places. So if you're looking at U.S. GDP compared to the U.S. history, we have the recession in 2000. Let's go back. I couldn't get a good chart back further. These charts are all Bloomberg, by the way. So you can see the recession in 1981, which was a steep recession, the steepest since the Great Depression before this year. You see at the peak of recovery, you're briefly over 8%. And the average is somewhere around 5%. Took about the early 90 recession. Again, 4%, down again, 4%, 4%. Recession in 2001. Again, all the way down to almost flat. Negative. This is a slope of negative GDP. So once the GDP starts to go down, you end up with a recession. And again, we have a brief peak up to 4. So you can look at job recovery. You can look at almost any other statistics that you'd like. Consumer spending, jobs created, particularly since that's the topic du jour de decade, or is there such a thing as de decade? I guess not. And by that definition, the U.S. performance has been very poor by our own standards. The average, this is a yearly average because these are quarterly numbers. I've just got a simple moving average. It's 2%. And if you go take a 2-year average, it's a little bit higher. Okay, so the U.S. average has been very poor. You could say half. Let's be generous and say half the average recovery of the past 20 years, or actually the past 30 years. But that's not the only comparison. Let's take a look. GDP, EMU. U.S. doesn't look so bad, does it? And remember, or at least we should note, the increasing globalization of the world, the increasing effect of united worldwide finances. They're not quite united, but the ability for money to shift around the world. All creations of the internet and what we've been dealing with. And every time we have a webinar, we end up talking about, at least somewhat, about the effect of the internet on our business, created it, on the world economy, and on national economies. And there's simply no escaping it. It's the evolution of our times. Remember, though, that in past eras, before the First World War, certainly, with the enormous, it's GDP, it's year-on-year GDP change, actually, is what it is. All right, so year-on-year, the economy grows 2% more than it did the year before, 3% more than the year before, or declines. That's what these graphs are. It's year-on-year growth measured quarterly. Before the First World War, it was a quite common opinion, not only among economists, but among politicians and others, that the 100 years prior, which had had an enormous increase in globalization and in world finance. Don't forget, the world was tied together by telegraph, and although it may not seem much to us, it was one, an enormous change, but two, except for the speed that was possible, which is much greater now in the amount of information, and the extent was much more limited than it is now. I mean, if you are almost anywhere in the world, you can quite easily get hooked into the internet and find, well, I don't know how easy it is, but you can certainly find access points within your country, within your community to access the internet. In the late 19th century, that was certainly not true about most of the world. But for the financial centers in the West, that was true. And there was much of an opinion at the time that the knitting of the world together, particularly the economic ties, would have made, and did make, they thought, another great war impossible. The nations and the governments had too much to lose. We, of course, found out, as did many, many millions of people in Europe, that that is not the case. So we should not make that assumption now either. Although, given the past history of the past 100 years, I don't think we're likely to make that assumption. So this is EMU. U.S. GDP looks infinitely better than EMU, both before the recession, although not quite as much then, but certainly since the recession. U.S. is positive. The GDP of Europe is not. Okay, let's look at another one. That was U.S. Japan. Japan is a sad state, but at least their GDP, they are trying. So, here's Japan. Same issue. These countries have not managed to sustain any type of economic recovery. Whatever you want to say about the U.S. and its economic policies, and also the flexibility of its economy, it is in better shape as far as these measures go. Even Germany, the powerhouse of Europe, the maker of Mercedes and other cars. I think I mentioned this statistic in most webinars, but I'll mention it again. Up until last year, the dollar value of German exports were the greatest in the world. More than any other country, including China, which has about 10 times its population. This past year, I think 2012, China surpassed Germany in value of exports. I find that the most astonishing figure for world trade. I think there are about 70 million people in Germany. China is about 1.3 billion, I think. The U.S. is 320 million. The value of German exports was greater than any other nation until last year. And that's just an astonishing figure. Let me ask this question here. What causes the oil fluctuation in price from 100 to 110? The oil market's a very interesting, there's history to it. But let me just do it briefly so you don't get too sidetracked. There are two factors involved. One, of course, is the view of the economy. Three factors. One is a long-term view of what's happening with the economy, the world economy. The assumption being that the world economy is going to continue to grow, and if it continues to grow, we'll continue to use more and more oil. Okay? That's demand. The supply side, how much oil is being supplied and at what cost. Okay? Second factor, are there any potential political problems that could constrict supply, such as the Iran-Iraq war in the 1980s, in which at one point Iran tried to choke off supplies coming from the Persian Gulf. Part of the reason this is so volatile is because a good portion, at least the marginal portion, actually it's a lot more than the marginal portion, I think it's about 30% of the world's oil, but I'm not sure, comes from the Persian Gulf states, Saudi Arabia, Kuwait, Oman, Qatar. Actually, I'm not sure Qatar has any oil. All of those states there, which are fascinating places. I have been there many times. It's a very, very interesting trip to go to Saudi Arabia or to Kuwait or any of those countries. I like it very much, actually. The trip, I find it very interesting. Because the production is not only localized, but it's localized in a way that is very susceptible to military threat. Whenever there is anything going on in the Middle East, that will raise the price of oil. The last question, or the last point, I think, is probably the past 10 years the most important. We all remember the price of oil at $150 before the great crash in 2008. What could possibly have caused that? The U.S. economy was already entering into a recession. World growth was declining precipitously. There were all sorts of problems. Bear Stearns had already, been sold. Any economist looking to predict what was going on for world growth could, and many did, predicted a crash. Yet the oil price right before that was $150. And the reason was because the oil market was essentially deregulated and moved out of the United States about 8 years before that, where they set up a competing, in the United States, the NYMEX had been regulated as far as who could participate, with fairly strict restrictions on participants having to have some sort of connection to the oil market, delivery, use, something like that. When they formed the Intercontinental Exchange, I think, in London, it was regulated, but there were no restrictions on participation. So that meant as long as you could find a seller, you could be a buyer. As long as you wanted to be a buyer, you just had to do is find a seller. So it became a much more both liquid and attractive market for speculators. Now remember, we're all speculators. Anyone who participates in the currency markets, it's not an investment. It's a trading market. So was oil. And so the volume of trade on ICE boomed. And of course, in order not to lose business, and NYMEX had to remove many of its restrictions. And so you ended up with an enormous amount of non-trade related activity on the markets. And this is of course, the era of the growth of hedge funds who are looking for places to make money, to improve their returns. And you have, of course, the ability of the internet to sort of fling money around the world here and there and everywhere and change markets anytime you want. I mean, if, anybody on our system wants to participate in the oil market, they can trade the oil price. We have it on our system as well. But as far as the market goes, it attracted enormous amounts of players. And as we all know, if we see, and you look at that oil chart from 5 years ago, if we, as traders, see a market that appears to be on a trend, a seriously strong trend, and we have an ability to participate in that, why would we not? And so that's what happened. That particular peak at $150 was driven largely by access to that particular market in London, which created everything else. There is and was no economic reason, cause and effect, for oil to be at $150. And I would say now as well that there's very little reason economically for oil to be at $110. But until there are alternative investment returns, there's going to be this type of flocking by the hot money, if you will, to instruments that can be traded actively and produce returns. After all, if oil goes from 85 to 130 and you're long, do you care whether this has any economic or any economic basis? No, not at all. And that's really the way it works. Part of this, of course, I feel is due to the financial repression, the low rates. Financial repression is the fancy term for it, having to do with low rates from the Fed. Okay. GDP growth means deflation. No, it doesn't. Deflation and GDP growth are not really connected. You can have, it's possible to have GDP growth with deflationary or certainly with disinflation. We have relatively, 2% average growth, and we have disinflation but not deflation. However, deflation, if it starts running, does tend to inhibit GDP. Because what happens is, and this has been one of the stories in Japan, what happens is that the firms lose pricing power. They can't raise prices even if their costs go up. And people will, at least in theory, put off purchases expecting the price to be lower, and all of that, of course, if there's no one out buying, then there's less need to produce. Okay, so back to our topic here. This is German GDP. Again, U.S. GDP. improvement. In fact, except for, of course, China, whose GDP is no doubt much higher than anyone else's except for developing country. And this is true for many other developing countries too. It's true for, although since China is the second largest economy in the world, I have my doubts as whether they should still be called a developing economy. I do not think they should be. I'll be glad to answer that in a minute. I'll talk about the dollar in general. So although this is a great decline here from 12 down to 7, that's 7.5%. Now, there are lots of people out there, a number of economists, who doubt the Chinese figures. I doubt them myself. Where they actually are is very difficult to tell. I've heard many cogent cases that Chinese economy is actually growing at 3% or 3.5%. I really don't have an opinion on those because I'm not really, let's put it this way. It's mostly speculation as to where the Chinese economy is. Again, the interesting fact of the statistics is or would be their effect on the world economy. Imagine what would happen in world markets if the Chinese did what the Greeks did back in late 2009 or 2010. Whoops. Our deficit is not 3.7, it's actually 12.4 or whatever it was. Whoops. What if the Chinese come out and said, whoops, our growth is not 7.5, it's actually 4. It would be a hurricane collapse in many of the world markets. So it not only behooves the Chinese, and the thing about Chinese statistics, I've always spoken about this, is that they tend to come out more or less where the government predicts they will. There's zero chance that that's coincidence. So if we look again, this is the second point of view. There are lots of factors going on in China. I think the primary one is that the way the numbers are collected, they work their way up in many cases from local levels. And every step along the way, they have an inherent, China used to, there's a history of a command economy in China. And if the Central Planning Bureau says that they want to have an 8% increase in screen production nationwide, then it behooves every factory manager to increase screen production 10%, regardless of how it's achieved or whether it's even accurate. So because many of the numbers are fed up from the lower level through various levels of the bureaucracy to the central offices in Beijing, every step along the way, every level of bureaucracy has an incentive to make sure that they increase, that they meet the expectations. Okay, so those are U.S. Again, the U.S. looks, let's just take a look at the 30-year with this moving average. The U.S. looks tepid compared to its history. It looks much more than reasonable compared to the developed world economies at the same time. And you can take your pick on this. For the United States, of course, for a culture and its people, they are most likely to be measuring themselves, especially a nation like the United States, against their own past rather than against European or other standards. It will do very little to make anyone in the United States who's without a job feel better about their situation or cope with it better to be told that things are worse in other places. That's really not a relevant statement, and I can't think of any American politician who would try that. So, let us now look at some of the other figures. We're going to look at the U.S. jobless rate. This is the U3 rate. This is the rate you always hear about. issue stands out here. It depends on where your reference is. Is your reference to the United States, as with Americans, or is your reference to the world? And it's my case, of course, that the U.S. reference is to itself. I mean, as I've said in almost every webinar that we talk about, I live in Manhattan. I've lived there since I went to college. Actually, I was born there. And I have never, ever seen as many empty storefronts as I've seen over the past 4 years. And the number doesn't go down. It stays steady. There are storefronts in my neighborhood on Broadway, which is one of the main commercial roads in Manhattan, that have been empty for 4 years. And there's still no tenants in them. So there is a real contrast between the semi-improving statistics that you see and read about, the economic commentary, which all economic commentary, except of course mine, should be taken with several grains of salt, especially commentary that's produced from a commercial point of view. Banks and other things. Their commentary doesn't necessarily reflect what the old phrase, you talk your book, but it does reflect a particular view of the world economy. And certainly if you're doing economic analysis for a brokerage, then your interest is to promote the brokerage. It may not be required, but it's just natural as it's your job. And brokerages only make much more money when markets go up because that's when they sell stocks. People don't generally buy stocks in a declining market, and it's very difficult for most people to short stocks. So anyway, so this is the U.S. Again, we have a huge rise and a fall. Now, I'll talk about how this came about in a second, but again, the reference to the United States is very poor. After the recession in 91, the unemployment rate got to about where it is now at the peak and then came off hard. Same here. And came off hard. Now let's look at some of the other Japan. EMU, the other great area, one of the other great areas of developed economies. This is the tenure. Now, I couldn't find a longer one because the EMU is a new nation. I don't want to look. We're going exactly in the opposite rate here, the opposite direction. So the comparison to the Europe, again, not much comfort in the United States, is good. Germany's interesting. Germany is the opposite of everybody. Look at this. Remember what I said earlier about the value of German exports. Germany had this small bump to 8%. But again, the direction of the chart belies the actual rate. The U.S. is now at 7.4. Germany's at 6.8. But Germany was at 12% back here. Germany actually did some large revisions in its labor force, its labor economy, and the benefit has been here. You can see it right here. I'll just put this up sort of for statistical reference. This is what the Chinese claim their unemployment rate is. As far as that goes, I can only say, okay. What else does one make of an unemployment rate like this? I don't know what to tell you. But there it is. That's what the Chinese claim the unemployment rate is. And Japan also. Now, Japan is much more statistically viable, I think, than the Chinese. Again, though, you see this peak and then decline down to 4%, up to 5.4. I'm not sure how the Japanese count unemployment, but it is true that Japan has a declining population and declining working age population. So that would, of course, lead to lower unemployment as a percentage. Let's take a look at some of the U.S. rates, okay? This is the 30-year jobless rate in the U.S. These are initial jobless claims. Okay, let's take a look at another one. This is the two. This is the U30 rate. We just looked at this. This is the 7.4. This is the U6 rate. That's called the underemployment rate. That doesn't go back as far. They changed their counting. This is now 14 points. This includes people who are working part-time and people who have not looked for a job in the past couple of months. This rate right here, which the U3 rate, it's a very restricted measure. You have to have, when they do their surveys, you have to have, well, most people probably know this, but in case anybody doesn't, you have to have looked for a job in the prior month. If you didn't, you're simply not counted. Which is, if anyone has looked for a job in a poor job market, is a very, from a government point of view and a politician's point of view, a very self-serving measurement. Which is why the U6 rate is a far more accurate depiction of what's actually happening in the economy than the U4 rate. And yes, you can look at the trend and say, well, the trend is the same, that's true. But there is an absolute measure here as well. People out of work, lack of purchasing power, lack of ability to buy things because they don't have a job, very restricted consumption. That's an absolute number and also a relative number. So this number, although it's always talked about, in my opinion, should probably be disposed of. Now, there's one other one of the labor. I'm looking for the labor force participation rate. I know that's here somewhere. Hold on, where is my? Sorry, labor force. Here it is. This is the key number for the jobless rate that you just saw. Let's put them up side by side, actually. These battery mice don't really work quite as well as the wire mice do. Okay, this is labor force participation, and this is the U30. Let's see if I have the U30 for 10 years rather than 30. No, I don't. We'll have to do it that way. Okay, hang on. Sorry about that. I would put these, I do these webinars pretty often, and I would put them in a PowerPoint, which gives you a much more organized presentation. But I feel that the spontaneity of this type of presentation makes for a much better webinar. You may disagree with me. I'm not sure. Okay, so here are the two charts we have here. Okay. Now, if we just take the period right here, let's take the period from 2005, which is right here, lines up pretty well, right here down. Okay, this is the labor. This is the unemployment rate, the U7, the U3 rate you keep hearing about. It peaks in late mid-2009, I think. Now, near the end of 2009. Okay, right there, right after President Obama's election, at around 10%, which is right here. And we have a quite precipitous decline, 2.6%, comes down by basically 25% from 10 to 7.4, 7.5%. That is the improvement that is continually number of people participating in the economy, in the labor economy, has gone to a historical low. This number right here is the historical low for the modern age. Modern age meaning after the 70s and the 80s, where women started participating wholeheartedly in the economy. Before that, the rate of female participation in the economy went much, much higher from the 60s on. And that, of course, raised the overall participation rate. You're no longer talking about just men working, but women working as well. The reason the U.S. economy, the U.S. unemployment rate has fallen 25% is because people have stopped participating, looking for jobs in the economy. So that as an component, say, of consumer confidence, which has a sentiment, which is largely a sentiment number, it has a positive effect. But as a comment on the ability of people to actually buy things and support the economy, remember, we've all heard the comment that U.S. economy is 70% consumption. Well, let's look at some of those numbers right now and see what they predict. Okay? Where shall we start? Let's start with retail sales. This is the one which most people talk about. Let me see if I have a third-year number here. Okay, let's use this one. This is the top-line retail sales. Now, retail sales is a number that is a nominal number. I mean, it includes inflation. It's not real. So when you look at numbers here, you can see that this 5.7, the real inflation is running a little less than 2% for 3.7. Again, the comparison here for retail sales, at least recently, is not that bad. It's really not. There is a general downtrend through here. It picks up again here. So for retail sales, and this is a comparative number. We're comparing apples to apples here because we're looking at the numbers from prior years, which are also nominal numbers, of course, because it's one series. So this doesn't look so bad. So if you're looking for a measure of the U.S. economy, of the driving force, consumer purchases in the U.S. economy, this doesn't look so terrible. Okay, now, let's take another number. Come on, computer. Let's take a look at the personal savings number. The personal consumption number. This is not a nominal number. This is the one the Fed looks at. This doesn't look so good. And I can't account for statistical differences between these two measures. I'm not a statistician. I was an FX trader. But this is the number that the Fed follows, not retail sales. This is the number the Fed is interested in. And this number looks very different. Remember, we're trying to figure out whether there is a reasonable case here for optimism about the U.S. economy. Go look at the retail sales number back here. You could say that there's a reasonable case. Yes, we had a huge collapse here, but these numbers compare well to the numbers back here, despite the unemployment. However, this number tells a different story. Not only is there a steady decline, which is part of a historical move, the kinds of trends that are culturally based and generally don't change, that even by that standard, if you run a line, if you run a trend line along the tops of these things, you would be over here someplace, somewhere around 4.5%. This is where we are now. So from a both historical and more narrow recovery point of view, personal consumption, again, the Fed's preferred number does not look so good. Let's look at some of the other numbers. Let's look at the more specific numbers. Car sales. Americans love their cars. It's people in this country. I assume I know my audience is pretty international because we don't actually take any clients here in the United States. We think nothing here about driving 2, 3, 4 hours to get to a place and be back. We have a house that I drive to. It takes 2 hours to get there, 2 hours back. We do it all the time. It's not really an issue. So we do very much put a lot of store in our cars. Now, this is a more specific number. The one thing that's deceptive about this number is, of course, it's not corrected for population growth. And that's true of the other numbers here. Now, the other numbers, because they're percentages, they don't matter that much. But this is an absolute number. So yes, this is a great recovery here. It's not far from averages. I didn't run an average on this, but from performance in prior years, certainly in these years. However, this spike here was caused by a Cash for Clunkers program, if I remember. Anyway, this is not corrected for population. So yeah, we're doing 15.6 now, and that compares very well with back here, except 30 years ago, there were 50 million fewer people in the country. So again, this number also does not show, even though it appears to, the type of robust growth that you might look at. Let's look at some of the consumer numbers. Consumer confidence. This is the Conference Board number. It tends to be a little more conservative than the Michigan number. This also does not appear to be the type of performance that is going to drive an economy to recovery. It's my thesis here that the case for American optimism is primarily a reference to overseas. It is not a reference to the internals of the United States or to American culture. And this is one of the things which gives me that point of view. The consumer confidence, the composite number, at 80 does not at all compare well to prior recessions, to prior history of the United States. So yes, things may be better, but if this is as good as it gets, then there has been a profound shift in the American consumer optimism. This is the Michigan number. Again, it's a little higher on absolute terms, but we see the same performance. There is not a return to the type of optimism that drives consumption and drives the economy. Now look at some reasons for this. Let's look at personal income. It may be that you want to spend, but people tend, unlike governments, like corporations, they exist in a world that they do not control. Therefore, their financial behavior must meet far more exacting standards than governments. This is U.S. personal income year-on-year growth. All these numbers I'm putting here are year to year. And you can see, this is a 30-year chart. This shows some of the same. As a matter of fact, you know what this chart looks like? Let's compare these two. This chart looks like the personal consumption chart that the Fed prefers as a measure to retail sales. And these two charts tell you, at least they tell me, that the consumer in the United States is a logical, rational creature. That within limits, it does not spend, we, I'm an American, do not spend more than we have. We may want very much to sustain in the face of declining financial capabilities or improve our life, our lifestyle, our consumption, however you want to define it. But these charts tell you that has limits, and serious limits. The income chart looks very much like the consumption chart. And we have two things at play here. We have the long-term decline, and we also have the absolute level that is nowhere near a return to consumption patterns that would support a much more buoyant and growing U.S. economy. This is not a great chart. It's actually average earnings. It's a different series of the same type of thing. I couldn't get it to go back because it's a relatively new chart, so let's not do that. We show this one as the labor force participation rate. Okay, now, the money has to come from somewhere. If you have this as income, The money has to come from somewhere that's being spent. This is one place it comes from. U.S. savings rate, 30 years. You could say it's the mirror image of the consumption rate and the earnings rate. Again, what the U.S. are doing is, Americans are doing, are they're saving less and spending more. Why? Because their income is no longer rising at the same pace that it was. Let's look at another one here. Now, this is total consumer credit. This is total consumer credit. Okay. Increase in consumer consumption. It's total. It's an actual number. So it should go up because, of course, the population rises. This spike here, I believe, was when the government took over college loans in 1 month. I forget exactly what that is. But anyway, so you can see the trend right here, and it's been rising since the recession, okay? People are using credit, as you would expect, it returns. Now, there are two types of credit. This is tracked by the Fed. There's non-revolving and revolving. Non-revolving is the type of credit that has a term. Not mortgages are not included. College loans, car loans, buying things on time. Why? Because you have to pay off the loan in a set amount of time with a set fee. That has been right now. This chart is compressed because the scale is compressed because of this unfortunate blip. But there's been a rather dramatic rise from, if you look back here, at the end of 2009, 2010, it was below zero. People were deleveraging. It's now up to $13 billion a month in fixed. So if people go to college, they take out a college loan, it shows up here. This is revolving credit. It's only moved up half as much. Most of the increase in total credit, non-revolving in total credit here, is because of the increase in non-revolving credit. People are going back to school primarily, and the biggest component of that is school. So we have two factors here. We have a decline in the savings rate, and we have an increase in both the absolute numbers of revolving credit and the absolute numbers of non-revolving credit. Again, these are the things that go into the economy. So people are borrowing to support their spending. Let's look at business spending here. This is called capital goods, new orders, ex-defense, non-air. No, non-defense, ex-air. I love these terms. What does that mean? Capital goods. This is part of the durable goods orders report. Capital goods. Goods meant to last more than 3 years. Durable goods. Capital goods. Goods bought largely by businesses. Non-defense. That means not government spending on defense. Ex-air. Meaning no civilian aircraft, which is largely Boeing because they skew the numbers. And here, again, we're talking about components of the economy that can support a case for optimism. We already looked at the consumer side. This is the business side. The thing about the business side is business spending is more volatile. I mean, it will start and stop depending on what the businesses think will happen in the future for consumption. So if they think they're going to get an increase in car purchase, they tool up the factories. They hire more people. Or more computers, or more placemats, or more computer, whatever it is. If they don't get that, they have both built up inventory and bought machines, the last thing firms do when they're anticipating or planning for at least an increase in production, the last thing they do is hire people. You can always get rid of a computer. You can throw it out. You can sell off inventory. It's much, much, much more difficult to fire people. It's more emotionally difficult, and it's harder both legally and all sorts of other ways. So the last thing firms do, is to hire people. So that's why if you're in a period here when firms are both investing in capital goods, that means place goods, inventory and machinery, plant and equipment, if you will, then somewhere along this rising line here from the 2001 recession, they'll start to hire. One thing we saw here in the rise from 2008 is that although firms stopped firing, they by and large did not begin hiring. And what happened here? Some of this is just replacement, where they didn't actually do the kind of maintenance that they normally would because they were terrified during 2008. So they started replacing things. But again, through here, the sales did not return to support the investment. Investment fell off. Then it picked up again. And there's an interesting pattern here. It's happened several times, late in 2011 and then mid-time in 2012. Everybody starts getting optimistic. They start planning for the year. Businesses inherently, and humans, I think, in general as well, have a tendency to look in terms of periods. Well, we have a new year. New Year's resolutions. Business is subject to this too. They were run by people. People and businesses tend to plan again for something which may or may not happen. And you see this over and over again here. Can FXG tell me, I know we're running right on an hour right now. Can someone, FXG, let me know how much more time we have so that I can plan. Okay, some other numbers here. These are more business numbers. Okay, this is the Chicago Fed National Activity. I have QE on this one. And this has been relatively steady since the recession. This is a measure of business activity. It doesn't have a lot of reference to QE. Last time we spoke about QE. And, okay, let me just do let me just answer a few questions here. And I will, let me put one of these numbers up and we'll talk about those. This is the ISM manufacturing number that we just got. This is the most traditional of the measures of what's happening with the economy. Let me tell you what would improve an economy. In my own opinion, what would improve the economy, I believe, would be attention on, after all, what produces jobs? Businesses produce jobs. Small businesses, medium-sized businesses, the ones that tend to hire. If you want to create growth, then give businesses incentives to do things, not disincentives. And I think those are fiscal policies. Those are government policies. They're not monetary policies. They have zero to do with interest rates and what the Fed is doing. It's as with buying a house. You don't buy a house. You buy a house, one, because you want to and need one, and two, because you can afford it. There is only a very small marginal percentage of people who buy based on the fact that they have low interest rates. Yes, it will get people to buy if they're already going to buy, but it's jobs. Same thing with business. People will hire when they have hope for increased sales. Thoughts for the dollar. I still think that the dollar index rises this year, and that is the primary reason is because the U.S. economy is going to perform better. And this is where the two ways of looking at the U.S. economy come into play. Americans are not going to be terribly happy. I don't believe the economy is going to power ahead. I don't think we're going to get much beyond 2, maybe 2.5% growth. This is nothing to bring down unemployment, to put people back to work. But it's going to be enough to get the Fed to stop and taper off QE. And between the better growth here and the weaker growth in our overseas competitors, and the end of QE, which I still think is going to be indicated in September, that will support the dollar. You saw once Mr. Bernanke back in May said that he was considering ending QE sometime soon, dollar got much stronger. You will see that again. And so I still think that is going to happen this year. I think there are a couple of reasons for that. One, and the primary one, I think, is that the ability, and this is what we spoke about last time, that the ability of quantitative easing to improve the economy has always been limited, and now it's pretty much flat. I don't think there's anything that quantitative easing is going to do. And two, you are getting bubbles in various areas of the economy. Housing, in my opinion, certainly in some local areas, but across the nation as well. And as someone asked earlier, oil. What's oil doing at $106 a barrel, $108 a barrel? When the IMF every quarter, or whenever they release it, I think twice a year, reduces the projected growth for the world economy. Why is oil rising again? Because it is a participation in that particular market by people looking for return. ISM manufacturing, the traditional view of the United States, looking huge rise from 50 to 55. Does this predict a better economy? I don't believe so. I believe so in the absolute sense. And to wrap up here, the absolute sense for the economy in the United States is I feel that as the year progresses, the U.S. economy will probably perform a little bit better. 2.5%, maybe better than 2%, as long as nothing else happens. I don't think that the withdrawal of QE will have any effect on that whatsoever. It will affect the markets. But the Fed's purpose in starting this entire discussion is to get the markets used to the idea, just the sheer passage of time, that quantitative easing is on the way out. After all, the Fed cannot continue to do this forever without actually blowing up the world. Okay, folks, I will let that go. If there are any questions or any other comments, I will put my email up there. Please send me a comment. I'll be glad to answer anything I can. I thank you all very much for attending. I know it's vacation everywhere around the world, and it'll be vacation here too. I'm actually going to be gone probably the last 2.5 weeks of August as well. And we have one more webinar, which I've not yet decided on the topic yet. If anyone has anything that they would like me to cover in a particular webinar, please let me know. I'll take all suggestions. I'll be glad to look at them. And I'd be happy to prepare a webinar. I actually enjoy these webinars a great deal. And I thank you all for attending. And I hope everyone has a lovely, I guess at this point, afternoon, evening, or night. And I'd like to thank FX Street for facilitating these encounters. Thank you all very much, and have a very good day.